Beijing is grappling with a mounting debt crisis. 54 trillion at the end of 2022.
This is the story of a huge change in the Chinese economy.
We know that China is doing very poorly right now.
China is getting absolutely hammered by tariffs.
In recent years, people have been focusing a lot on America's rising government debt. The U.S. now spends huge amounts just to pay interest on this debt, and new laws are making the deficit even worse. Since the U.S. dollar is the world's reserve currency, the country has more freedom to borrow than others, but not forever. The U.S. government is now the most indebted organization in history, and someone will eventually have to pay, whether it's taxpayers, everyone through inflation, or future generations through collapse.
And Donald Trump came in, the debt exploded. Joe Biden came in, the debt exploded. Both parties over the past 25 years have been extraordinarily reckless. We're now talking about adding another $20 trillion in the next decade. Go from having a $37 trillion debt to a $57 trillion debt in a decade. That's not sustainable.
On the surface, China seems to be doing much better in terms of debt management. According to official numbers, China's debt is about 84% of its GDP, which looks more responsible compared to the US at 123%, or Japan at around 250%. Plus, China owns a large chunk of American government bonds, which makes it appear to be a powerful and disciplined lender rather than a reckless borrower. But that image doesn't tell the full story. In reality, China's overall debt may be far larger than the official figures suggest. While the U.S. openly lists most of its debt at the federal level, China handles things differently. Much of its borrowing is distributed across provincial and local governments, as well as state-owned enterprises and special entities created to carry debt off the official records. These debts are often underreported or not included in public financial data, which means the true size of China's debt could be significantly higher than what's shown.
Beijing has been pushing local governments to curb debt risks for years, especially hidden debt. That's the debt that's racked up by financing vehicles on behalf of municipalities, which doesn't show up on the balance sheets of the localities.
By the year 2023, China's local and provincial governments had taken on at least $12.6 trillion in debt, which alone amounts to about 76% of the country's total economic output, GDP. When you also include the central government's debt, China's total government debt jumps to around 160% of GDP, a number that's much higher than the United States debt level. But that's not the full picture. This estimate still doesn't take into account the debt held by state-owned enterprises, SOEs. These are companies that are technically supposed to function like private businesses, but in reality, they mostly follow the instructions of the Chinese government. They often take on large infrastructure projects, both inside China and abroad, using money borrowed through state-backed banks.
In the city of Zunyi, there's a road that speaks volumes about the state of the Chinese economy. A multi-billion yuan expressway, one side unfinished and abandoned, a symbol of a system that's stuttering.
A study by Stanford University revealed that China has over 390,000 fully state-owned companies, and more than 1 million others that are partially owned by the state. These companies have borrowed an estimated $30 trillion. If these businesses are unable to pay back their loans, the responsibility could fall back on the government to bail them out. When you combine all this borrowing, from the central government, local governments, and SOEs, China's true debt could be over 300% of its GDP. And things might actually be even worse. Several economists suspect that China's official GDP numbers are overstated, meaning the economy may not be as large as the government claims. If the real size of the Chinese economy is smaller than what is reported, then the actual debt-to-GDP ratio could be as high as 450%, which would be far beyond the levels seen in the United States or most developed countries. Despite all this, China's borrowing costs are strangely low. While U.S. government bonds pay about 4.5% interest, Chinese bonds pay only 1.7%. This doesn't make sense since China is considered riskier. The reason is that China's financial system is not a free market. Capital controls prevent most Chinese investors from moving money overseas, so they're forced to buy low-yield local bonds.
Chaos erupts at the headquarters of cash-strapped developer China Evergrande Group. About 100 disgruntled investors, home buyers, and even its own employees flocked to the firm's lobby Monday to demand the repayment of loans and financial products.
Also, China's stock market isn't a good alternative. It has barely grown since 2000, and government interference makes it unstable. Even big companies can be punished for political reasons. As a result, investors don't trust the market, and Chinese businesses struggle to raise money for real innovation. Household spending is also very low in China. While Americans drive 68% of the U.S. economy through consumption, China's rate is only 39%. Economists would expect poorer countries to spend more on essentials, but in China, many people save rather than spend, partly due to cultural habits, but also because of limited investment options. So while China may look financially healthier on paper, the reality is more complex. Its debt is hidden, its economy is tightly controlled, and its growth is less stable than it seems. And even though China appears to have more control over its finances than the US, both countries are facing serious long-term challenges. Since the early 2000s, China has earned massive income through exports, but hasn't spent much of it. In fact, Chinese real estate is now the largest asset class in the world. As people poured their savings into property, prices skyrocketed. In Beijing, the average home costs around 35 times the average income, far more than in cities like London or LA. Since there aren't many other options, real estate became the default way to grow wealth.
A prolonged housing crisis in China having a knock-on effect on the rest of the economy.
But the housing boom has created another issue: deflation. While property prices soared, prices of everyday goods barely moved in 25 years. This happened because people saved aggressively to buy homes, leaving less money for consumer spending. China became great at producing goods, but struggled to consume them. From 2000 to 2019, the U.S. money supply tripled, but China's grew 16 times, meaning they printed money at a much faster rate. They do this by using state-owned banks to create and lend money directly to government departments or state-run companies. Unlike the U.S., China's inflation stayed low because people don't spend much, so prices haven't risen much, at least in consumer goods. By debt-to-GDP standards, China's situation looks alarming. Some economists say a 120% ratio is a crisis point. China's is around 300%, maybe more. That said, China also owns a lot of valuable assets. Unlike countries like the US, where governments hold relatively few assets, China owns all land, major companies, and most utilities. Estimates suggest China's net worth is $20 to $40 trillion, giving it more financial cushion than most countries. These assets also mean China could, in theory, reduce its debt more easily. One major advantage for China has been low borrowing rates, but only the central government benefits from those. Local governments and state-owned companies often pay high rates, up to 10%. So while borrowing has been easy, it's unevenly distributed and potentially risky. Another big problem is that real estate is where China's inflation has actually shown up. But real estate isn't very productive. It doesn't create jobs or innovation like a strong private sector would. If China's property bubble bursts or real inflation hits, the situation could worsen quickly. Ultimately, China's economy operates very differently from others like the US. It's tempting to think that China's rise will match America's decline. But both are struggling in their own ways. If their relationship completely breaks down, it wouldn't produce a winner. Only losers on both sides. What are your thoughts on this? Feel free to share in the comments below and subscribe to our channel for more such informative videos.